The Fed's already printing. Now it's modest. It's not anything crazy yet, but the balance sheet is going the other way. Another really, really important one, ISM Manufacturing print came in expansionary again. So manufacturing is expanding. 2 months in a row is a trend. ISM PMI came in at 52.4. This historically has been incredibly bullish for Bitcoin. This means the business cycle is here. Traditionally, when the business cycle starts to pick up like this, when ISM starts to pick up like this is the beginning of a Bitcoin bull market. This is where Bitcoin finds its bottom.
Historically, Bitcoin has been extraordinarily sensitive to shifts in global liquidity cycles. When money becomes easier, risk assets tend to thrive. When liquidity tightens, the opposite happens. This relationship has played out repeatedly across every Bitcoin cycle since its creation. Now, according to Strike CEO and longtime Bitcoin advocate Jack Mallers, several key indicators suggest that the liquidity environment may already be changing again. In the latest episode of his weekly podcast, Mallers highlights something that has received surprisingly little mainstream attention. The Federal Reserve's balance sheet has quietly begun expanding again after years of quantitative tightening. While the Fed has not formally announced a return to quantitative easing, the numbers tell a different story. At the same time, another macro signal is flashing historically bullish conditions for Bitcoin. The ISM Manufacturing PMI has returned to expansionary territory, printing at 52.4, marking 2 consecutive months of growth in manufacturing activity. According to Mallers, this is not just another economic data point. Historically, when the ISM begins trending upward again after a slowdown, it tends to coincide with the early stages of a new business cycle, a period that has often aligned with the beginning of Bitcoin bull markets. But in his latest podcast, Mallers argues that the story doesn't stop with liquidity and economic cycles. In fact, he believes something even larger may be unfolding beneath the surface, a structural shift driven by artificial intelligence, labor disruption, and the extreme leverage embedded within the modern financial system. To understand why Mallers believes this moment could mark a turning point for both the economy and Bitcoin, we need to begin with an important trend Jack highlights in his video. Before we proceed, if you enjoy deep macro analysis like this, make sure to like the video, subscribe to the channel, and turn on notifications so you never miss our future breakdowns. Thanks, and enjoy the video.
Okay, this is on the left, this is job openings in finance and in insurance. Again, I'm just sorting by white collar. Guys, please look at the job openings for finance and insurance. We're at levels lower than COVID. We are at post-global financial crisis levels. This is, by the way, this is the U.S. Bureau of Labor and Statistics via Fred. I didn't make these images myself. Look at the job openings on the right. Information. I mean, again, I'm a college dropout. I'm no genius. What? Just look at the data. Now, this shows you how fast AI is moving. To me, the title of this slide is the most important chart in the world. So AI capability is doubling every 4 months. It's growing 100% every 4 months. And it's grown 26,000 times since GPT-2 came out. I want to read this tweet to you guys. This is banana land. We estimate that Claude Opus 4.6, so the new Claude model, has a 50% time horizon of around 14 and a half hours on software tasks. Let me translate that to language for you guys to understand. What that means is that the latest Claude model has about a 50% chance of achieving a task that would have taken a human 14 and a half hours, and it can do it in seconds. I'm going to say that one more time. The latest Claude model has a coin flip of a chance of achieving something in a matter of seconds or maybe minutes that it would have taken a human 14 and a half hours to do. And look at the title of my slide. AI capability is doubling every 4 months. So in 4 months from now, it'll take seconds to do what it took a human more than a day to do. And then 4 more months from there, it'll take seconds for what it took a human half a week to do. And it's only a matter of time before it is seconds before it can do what a human can do in a year. The rate of change, it's hard to comprehend. No, but your jobs are fine. Your jobs are fine though. according to the Fed. The subprime market was fine. The COVID inflation was transitory. Your jobs are all good. All good. Markets are fine. Well, let's look at how confident people are. U.S. adults' optimism about their future has fallen to 59.2%, the lowest ever. Here we are, K-shaped economy, AI disruption. Wealth is being highly concentrated into the most elite class we've ever seen. Stock markets are at all-time highs, but everyone's depressed, overdosing on pills, substance abuse, all-time highs, obesity, all-time highs. Assassination attempts are rivaling the mid-1800s, which was the Civil War. How am I more accurate and speaking more truth than the Fed, than mainstream media, than the government? It's outrageous. It's all in our face, too. Like, all you have to do is read the news. Chapter 3 here, I've titled Leverage Kills. And the point of this chapter is just what I'm here. I want to be super clear. I'm not saying AI is going to take everyone's job, because I've gotten that feedback. It's like, dude, you're like being so pessimistic. It's so depressing listening to you. Like, what? We're all going to be like sitting in on our phone on TikTok and watching Elon's robots do everything. That's not what I'm saying. In fact, I'm on record saying I think we're going to have an art renaissance with Bitcoin and AI. We can be future-oriented artists and creators. We don't need to do the white-collar, mundane tasks of doing other people's taxes, for example. But whatever. Back to my point. My point is, I'm not saying all the jobs are going to be taken. Not at all, actually. What's relevant when it comes to macro, when it comes to money printing, when it comes to a lot of the things we talk about, is the system is so highly levered. You're talking about $40 trillion of debt, okay? All it takes is a little bit of pain for a system this levered to collapse on itself. How do I know that? Well, just take a look at 2008. So this slide reads the lesson of 2008. In February 2008, the mortgage delinquency and foreclosure rate hit 7.3%. Now, let documentaries tell it. Let exaggerators on Twitter tell it. You'd think it hit 73%. It's 7.3%. So what does that mean? What's 100 minus 7.3? That means 92.7% of mortgages were still current. But that 7.3% combined with all of the systemic leverage that the fiat financial system requires was enough to collapse the global banking system and just flatten it on its face. So what's my point? My point is AI doesn't need to take all the jobs. AI needs to take a little bit of the jobs. If unemployment gets to 6 to 8%, this fiat system is toast. Like, completely and utterly screwed. Mind you, also, if we're going to be in war in the Middle East, if oil is going to start to market up 10%, inflation is coming back, bond market is selling off. Guys, if there's a flight to safety, the bond market's not supposed to sell off, okay? Like, you combine all of this at once.
What Mallers is pointing to here is not a single problem, but a fragile system where several pressures are quietly building at the same time. Historically, financial crises rarely begin because everything suddenly breaks all at once. They begin when a highly leveraged system encounters a relatively small disruption that it simply cannot absorb. The global financial system today carries significantly more debt than it did before the 2008 financial crisis, which means its tolerance for stress is arguably even lower than it was back then. And this is where the connection to AI, employment, and the broader macro environment becomes important. If technological disruption begins to quietly chip away at parts of the labor market while geopolitical tensions push energy prices higher and government spending accelerates, the system begins to face pressure from multiple directions at once. Even modest increases in unemployment or inflation can quickly spiral into something far larger when the underlying structure is already stretched to its limits. Let's get back to Mallers' video as he expands on this vulnerability by highlighting new warning signals from the housing market, banking system, and government finances, and most importantly, what it all means for Bitcoin.
Breaking. Jamie Dimon says he's starting to see parallels to the era before the 2008 financial crisis, when a rush to make loans ended disastrously. I mean, if if that was a Jack Mallers quote, okay, we'd be busting balls about it on Twitter. That's a Jamie Dimon quote? Yikes. Yikes. Okay? The image on the right, there are 44% more home sellers than buyers. Guys, that means there's stress. If you are nervous about your future, if you are nervous about your job, if you are nervous about your finances, if you are nervous about the economy, the first thing you do is stop looking for a house. Screw it, I'll extend my rent one more year. Extend my lease one more year. 44% more sellers than buyers? Yikes. Yikes. Not good. Not good. Okay, the fiscal doom loop. This is the math on you either have to print or default. This image I got from Luke. Shout out Luke. So this is U.S. true interest expense as a percent of U.S. tax receipts. So from a high level, what is our expense versus how much are we making? How much do we have to spend versus how much are we making, right? So employment is over 50% of federal receipts, and true interest expense is already almost 100% of receipts. Think about that. True interest expense is almost all of the revenue we're making, basically. So even the tiniest bit of an AI-driven uptick or a correction in the stock market or a war, and the tiniest bit, boom, goodbye. So the point of this episode, you've got new conflict in the Middle East. So you've got war spending now. Initially, Trump said, oh, this is only a quick operation. We just need to take the regime out. Then it was 4 weeks. Now Trump, as I hit record or stream, was saying it might be more than 4 weeks. Okay, so we might be on the brink of wartime spending. It's unclear how the oil market's going to respond, which would trigger some inflationary tendencies. So you've got war spending and oil shock, AI deflation, which is impacting unemployment, which impacts receipts. And we're already at true interest expense of 100% of our receipts, nearly. Good game. Turn on your DCAs. When Bitcoin hits the moon, you can't say I didn't tell you so. You cannot say I didn't tell you so. And this from Michael Howell, Cross Border Capital. I already had mentioned him. I would subscribe to his newsletters if you don't. I really have been enjoying his stuff. The Fed's already printing. Now, it's modest. It's not anything crazy yet, but the balance sheet is going the other way. Just a reminder, guys, they stopped QT in December. Now, what they started isn't technically QE. I count it as QE, but it's balance sheet expansion. $525 billion in 3 months, 20% of annualized Fed liquidity growth over the past 6 months. I don't know, okay? Another really, really important one, ISM Manufacturing print came in expansionary again. So manufacturing is expanding. 2 months in a row is a trend. ISM PMI came in at 52.4. This historically has been incredibly bullish for Bitcoin. This means the business cycle is here. Traditionally, when the business cycle starts to pick up like this, when ISM starts to pick up like this is the beginning of a Bitcoin bull market. This is where Bitcoin finds its bottom. Now, please don't take that as financial advice. Just turn on your DCA, stay humble, and stack sats. But these are all really important signal, guys. Really, really important signals. So let's get to the last chapter, which I call Deep Value, where generational wealth is built. This is the most oversold, according to RSI, Relative Strength Index, that Bitcoin has ever been. Bitcoin at $65,000 is the most oversold, according to RSI, in Bitcoin's history. History. I've seen Bitcoin post Mt. Gox. I've seen Bitcoin. The 2015 bear market was the worst. Guys, I remember running up to my dad's room when Bitcoin hit. It was almost $1,300 and just freaking out like, oh my gosh, what's happening? Holy smokes. And then it fell from, call it $1,300 to a little over $200 over years. It just it looked like it was just slowly dying to zero. And we had nothing, no exchanges, no support from any industry, from any government. We had nothing. I didn't even know how to code at the time. We had nothing. You're telling me it's more oversold now than then at a $200 Bitcoin? All of these charts, by the way, this guy's a great follow on Twitter, this Frank guy. Just turn on your DCAs. I mean, this slide says it all. Sorry, I'm looking at the clock. I want to be able to run you guys through these strike announcements. So this slide reads, this is where wealth is built. The system needs the printer. You talk about war, talk about oil marketing up, talk about AI deflationary tendencies, talk about true interest expense near 100% of our receipts. I mean, it's math. It's math. People say, wow, how'd you Bitcoiners know the future? Is knowing that 2 + 2 = 4 knowing the future? Does that make me a fortune teller? Jack, what's 5 + 5? 10. Wow, you know the future. I don't know about that. I know how to do math. The system needs the printer. The only question is when, not if. Bitcoin is on sale at historic oversold levels. Turn on your DCA. Turn it on. Turn it on.
In the final section of the podcast, Mallers turns his attention to signals that suggest the stress he described earlier may already be beginning to surface. One of the most striking examples comes from JPMorgan CEO Jamie Dimon, who recently warned that certain trends in lending and credit markets are starting to resemble conditions seen before the 2008 financial crisis. For Mallers, this kind of warning carries weight precisely because it is coming from one of the most influential figures inside the traditional financial system itself. He also points to growing weakness in the housing market. Data now shows there are significantly more home sellers than buyers in the United States, a sign that households may already be feeling pressure about their financial future. Historically, housing slowdowns tend to appear early in economic downturns because buying a home is one of the first major financial commitments people delay when uncertainty begins to rise. When confidence drops, demand disappears quickly. But the issue Mallers believes could ultimately prove most consequential is the math of government debt. According to the data he highlights, the U.S. government is approaching a point where interest payments alone are consuming nearly all federal tax revenue. In simple terms, that leaves policymakers with very limited options if economic conditions deteriorate. Either spending must be reduced dramatically, taxes must rise significantly, or the monetary system must rely increasingly on liquidity creation. This is why Mallers arrives at a very different conclusion than many analysts who are currently predicting deeper downside for Bitcoin. In his view, the macro conditions forming today, rising debt burdens, geopolitical tensions, technological disruption, and expanding central bank liquidity, are exactly the kinds of forces that have historically pushed capital towards scarce assets. From that perspective, the recent weakness in Bitcoin may not signal the start of a larger collapse, but rather the kind of oversold environment that has previously marked the end of major bear phases. Of course, no one can predict the future with certainty, but if Mallers' thesis proves correct, the period many investors currently see as uncertainty could eventually be remembered as the stage where the foundation for the next cycle was quietly being built. If you found this breakdown useful, let us know your thoughts in the comments below. Do you agree with Jack Mallers that Bitcoin may already be forming its bottom, or do you think the market still has further to fall before the next bull phase begins? Don't forget to like the video, subscribe to the channel, and turn on post notifications so you never miss our next deep dive into the forces shaping Bitcoin and the global economy. Thanks for watching.